Copper futures are consolidating near historic record levels, with COMEX 3-month copper trading above $6.40 per pound, equivalent to over $13,500 per metric ton on the London Metal Exchange. While headline stock indices remain sensitive to short-term interest rate chatter, physical commodity markets are signaling an acute tightness in raw materials. Global warehouse inventories continue to demonstrate severe regional fragmentation, with COMEX stockpiles holding steady while spot deliverable copper concentrate outside the United States remains under significant structural pressure. The ultimate measure of this physical scarcity can be seen in smelter treatment and refining charges, known as TC/RCs, which have effectively collapsed to $0 per ton, signaling that copper concentrate availability relative to global refining capacity has reached its tightest level in modern market history. To understand the institutional money flows driving copper to these levels, we must look directly at foreign exchange mechanics and central bank policy. As the Federal Reserve moves through its current monetary cycle, the US dollar index, DXY, has settled into a defined consolidation range near 100.90, removing a major foreign exchange headwind for dollar-denominated physical commodities. Simultaneously, real 10-year Treasury yields have moderated, reducing the opportunity cost of holding non-yielding physical hard assets for large institutional asset managers. When real yields compress while industrial consumption remains sticky, capital flows naturally shift out of fixed income instruments and into hard asset producers capable of capturing physical inflation. Unlike precious metals, which react primarily to monetary debasement and safe haven flows, industrial metals like copper capture both monetary liquidity tailwinds and structural physical demand growth. Moving to the physical fundamentals, the copper market is facing an unprecedented structural deficit that mine output simply cannot bridge in the short term. Global mine supply growth for 2026 has been revised lower to just 2.4%, driven by operational setbacks across major global producing regions. Chile, the world's top copper-producing nation, reported a year-over-year production decline of over 9%, impacted by weather disruptions and operational constraints at legacy state operations. Compounding these supply constraints is the physical timeline required to bring new greenfield copper mines online, which currently averages 12 to 15 years from initial discovery to commercial extraction due to environmental permitting and declining global ore grades. On the demand side, physical consumption is being permanently altered by the rapid expansion of artificial intelligence infrastructure and global power grid modernization. A single gigawatt-scale AI data center requires between 25,000 to 50,000 metric tons of copper for heavy-duty transformers, busbars, and distribution units, creating an inelastic demand driver that persists regardless of standard economic cycles. For U.S. equity investors, this structural deficit translates directly into significant free cash flow expansion for premier domestic upstream miners. The leading beneficiary in the U.S. market is Freeport-McMoRan, NYSE, FCX, the world's premier publicly traded copper pure play. Because FCX maintains a largely fixed cost structure for its mining operations, every 10-cent increase in realized copper prices adds approximately $350 million to $400 million directly to its annual EBITDA. Our second key winner is Southern Copper Corporation, NYSE, SCCO, which boasts industry-leading copper reserves and some of the lowest cash operating costs globally. SCO's high operating margin buffer provides exceptional cash flow resilience, allowing the company to return substantial capital to shareholders via dividends while maintaining robust balance sheet flexibility. For investors seeking broad sector exposure without single company execution risk, the Global X Copper Miners ETF, NYSE, COPX, offers a targeted basket of Tier 1 global producers. COP provides direct equity upside to physical copper pricing while smoothing out localized operational risks across individual mine sites. While upstream extractors benefit from expanding margins, sustained high copper pricing acts as a direct margin tax on downstream U.S. industrial sectors. Unhedged electrical equipment manufacturers and power hardware integrators represent the first wave of margin risk, as rising copper procurement costs squeeze gross margins when input price increases cannot be immediately passed on to end customers. The second major sector facing margin compression includes high-volume consumer durables, appliance makers, and industrial machinery producers. In these high-volume manufacturing businesses, raw copper represents a significant percentage of total bill of materials costs. When spot copper remains elevated above $6 per pound for consecutive quarters, these downstream manufacturers typically experience a 150 to 250 basis point reduction in operating margins, making selective stock picking critical for U.S. equity portfolios. Looking at the technical chart roadmap for COMEX copper futures, $5.80 per pound serves as primary institutional support, with $6 acting as a key psychological pivot level. To the upside, a confirmed breakout above $6.40 opens the technical pathway toward the record high resistance zone between $6.65 and $6.72 per pound. Over the coming week, institutional investors will be monitoring upcoming S&P Global PMI reports, US dollar index volatility, and weekly inventory changes across LME and COMEX warehouses for further confirmation of physical market tightness. Any short-term price pullbacks driven by broader macroeconomic sentiment should be evaluated through the lens of long-term structural supply deficits rather than fundamental weakness. Make sure to subscribe to Global Macro Pulse, and we will see you in the next update.